Our expectation remains that silver is highly likely before the end of this year, which is to say a handful of months, take out its all-time nominal highs, $50, and end up in the 60, 70 range before it even pauses. Okay, not that that's the top, but just that. And if you think about it, like, you use the word nominal, I think. If you think about it in real dollar terms, I mean, good grief, if you factored in the growth in the money supply, degradation of the money unit, since 1980, when silver was at 50, or since 2011, when silver was at 50, very briefly both times, by the way, silver would probably have to be $200 right now just to be equal to those highs, okay? And don't be surprised if that's what ends up happening.
In today's news recap, volatile prices stifle gold demand in top Asian hubs. Physical gold demand in key Asian hubs remained subdued this week as price volatility kept buyers at bay, while jewelers in India resumed purchases ahead of a key festival season. Gold prices in India were trading around 99,300 rupees, $1,135.77 per 10 grams on Friday, after hitting a record high earlier this month. With prices easing, jewelers are feeling more confident about festival demand and have slowly started buying again, said a Mumbai-based bullion dealer with a private bank. Indians will celebrate the Dussehra and Diwali festivals in October, when buying gold is considered auspicious. This week, Indian dealers were quoting between a discount of $2 per ounce and a premium of $3 per ounce over official domestic prices, inclusive of 6% import and 3% sales levies, compared to last week's discount of up to $6. Retail buying is still subdued, currently at around 60% of normal levels, said Amit Modak, chief executive of PN Gadgil and Sons, a Pune-based jeweler. In top consumer China, bullion changed hands between premiums of $3 and $8 an ounce over the global benchmark spot price, which traded in a range of $3,358 this week, down 0.2% so far for the week. With gold in the doldrums, there is scope for exaggerated moves on news from Jackson Hole, which reflects the thin trading conditions currently gripping the market, said Ross Norman, an independent analyst. In Hong Kong, gold was sold at par to a premium of $1.70, while in Singapore, gold traded between at-par prices and a $2.50 premium. We've seen a bit of retail buying, but nothing really substantial. In the jewelry space, demand has been quiet because prices are high, said Brian Lan, managing director at Singapore-based Gold Silver Central. Now, we'll show you the best clips of the latest interviews, but first, smash the subscribe button and turn on notifications so you do not miss out on our recaps.
I think this time around, it's different. I don't think we have a normal bull market in monetary metals here, where you're going to go up to gold, $850 and then drop back to 200 like it did between 2000. Go up to the $1,920 high in 2011 and drop down to 1,050, that kind of stuff. I think there's enough major macro, technical, and fundamental events underway globally, but also focused in the U.S. because we're the greatest error out there right now in terms of the bubble, stock market bubble particularly. That when that breaks, and it will, and I think we're in the process of topping the S&P and the NASDAQ and breaking that bubble, that the consequence monetarily will be a global shift here, there, more, there, countries adopting money that's backed by gold as opposed to fiat. I think that thought is already out there. The Chinese are already expressing it to other countries as well. And silver is, after all, I know everybody likes to think it's an industrial metal, but if you go back and look at its history, its major swings up and down, forget about this week or that week, okay? It moves with gold. It doesn't move with industrial metals, okay? Sometimes the industrial metals like copper and so forth are in sync with silver, but don't let that confuse you. It really does not follow the commodity complex so much as it is in step with gold. So even silver could be monetized. Okay. And already we're seeing some state legislatures, I can't get into detail, but Florida, Texas, and there's a lot of others who've said not only they're not going to tax gold and silver transactions, it's just like money, buying something. They are legal tender. Whoa, what a statement. I mean, when a state government describes gold and defines gold and silver in their state as legal tender, in fact, I think in some of them you can pay your taxes in it. Florida, I think, has set up agencies to service tax payments through gold. They're in effect rebelling, miniature rebellion against the national monopoly, Federal Reserve, etc., over what is money. They're saying, no, we decided this is money. Okay, that's a rebellion. And I think as the events of the unwinding of the asset bubbles that have been boomed by monetary expansion, by free money for 10 of the last 15 years, et cetera, that when that breaks, all the errors associated with that bubble that are exposed during the breakage process, much worse than we saw in 2008 and 9, for example, in terms of real street events. That's when people rethink what is reality, what works. That really hasn't worked. Let's get rid of it. It becomes emotional at some point. And I think we're on the cusp of that. That's what I think will help drive the acceleration phase in the monetary metals. It's already underway. They're anticipating reality. They don't wait for it. Gold rarely waits for the stuff that you look back and say, oh, now I understand why it went up. It knew it ahead of time. Okay, somebody did. And I think we're at that phase now where once that other stuff crumbles and that asset flows start to seek homes elsewhere, well, there's usually very few homes for it, safe places, gold and related, and T-bonds. T-bonds aren't working this time. So it leaves you one thing, monetary metals. And if you look at the behavior of the gold miners, it suggests to me, like Newmont, for example, which is not an outperformer right now. It sometimes is an outperformer in the sector, sometimes underperformer. It's resurrecting itself, but it's still not outperforming GDX, for example. But it has exploded. It's up like 60, 70% this year. Nobody's pounding the table. You don't hear it on the financial TV networks. Look at Newmont. It's up, instead they're cheering the fact that the S&P is like, oh, it's 5-6% above its old high. Oh boy. And I think the S&P right now, as we speak, is up about 9% on the year to date, where it closed last year. The gold miners are up 60, 70% on the year. Okay. Anyway, this is unfolding, and I think it will speed up. And once it reaches certain levels, I think it will become institutionalized again. Gold as real money.
And then silver will follow. That makes a lot of sense.
It will follow, and I don't think it's going up and it's going to crash back down to $20 or something like that. I think we're in a different global monetary economic environment.
Huge news from China, Hong Kong drawing up plans to support gold trading. Special Administrative Region government is stepping up efforts to become an international gold trading hub and is reviewing related areas, including support for physical gold delivery, with plans to be unveiled later this year. As the city is making progress in building a commodity trading ecosystem, Chan underscored Hong Kong's advances in the non-ferrous metals market. Earlier this year, the SAR became a part of the London Metal Exchange's global warehouse network, an achievement he described as a significant milestone that has brought China closer to the world's most active metals trading markets. 8 LME-approved warehouses in Hong Kong have been operational since January, with more than 8,000 metric tons of exchange-registered warrants available to facilitate anticipate LME contract delivery as of early August, according to Chan. Beyond ensuring a stable regional metal supply, the move could also strengthen Hong Kong's shipping industry and support the growth of related services such as trade finance insurance and risk management hedging and derivatives. He added, the development in commodity trading is an example of Hong Kong's efforts to harness the opportunities arising from the technological revolution and a shifting global trading landscape to drive its economic transformation and upgrading in order to foster new growth engines, Chan said. So safe to say that BRICS master plan continues and the US dollar takes the L. Now, we'll show you the best clips of the latest interviews, but first, smash the subscribe button and turn on notifications so you do not miss out on our recaps. And check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trading the gold-silver ratio and increase your ounces. With this easy-to-read book, you'll know everything you need to know to stack efficiently so you don't have to rely on market commentators. Enjoy the episode.
And in fact, silver, I think, made a secondary high at $35 in March, if you recall. And since then, if you look at gold, like from April close to the present, May, June, July, now in August, okay, total sideways. You almost go back in history and never find an instance where gold goes to sleep, especially after a big advance. Well, what we tell people is, hey, gold doesn't top this way. Never. Okay. When it tops, it tops. You make a high, you drop sharply, and then you work your way on down. But during that time when gold was asleep, silver went up. Gold miners, silver miners went up sharply. In fact, since April, you go back and look. It's just an amazing wake up for what had been the sleepy end of the monetary metals sector, silver, gold, silver miners. So they're back into a technical leadership position versus gold. And ever since April, you can see it. Gold sideways, they go vertical. Okay. And I think that's going to continue, that outperformance by the silver and the gold and silver miners. So gold is still in the stall mode. I suspect it's going to come out of it very shortly. Maybe they're waiting on the talks today, the big Trump talks with the Europeans and all that stuff, which really doesn't matter in the long term anyway. But sort of underperformed GDX, not dramatically, but in 2021, it peaked versus GDX in terms of performance, meaning the silver miners were beating the gold miners. Okay. But when we went into that stall from mid-2020 surge highs in the monetary metals, for several years, gold went lateral in a range between mostly 1,700 to 2,000, briefly got down to low 1,600s. But silver and the gold and silver miners actually eroded. They went into like a staircase. And during that time, not only did SIL go down versus the others, but it went down more. Therefore, its relative performance was weak. Just like silver relative to gold was weak. Okay. The recent reassertion by the miners, silver miners especially, and silver, has broken the technical of that erosive process when you plot it as a spread. And if you look at the silver miners even year to date, they're up more than the gold miners. So they're catching up, okay? It's like a wet bar of soap because they're such a tiny little sector. Even the whole mining sector is gold, silver mining, but silver especially. That when money flows into that sector, it's like the wet bar of soap. Everybody's grabbing it, it just scoots. And so we've seen some very dramatic action. Now, even recently, price has almost always lagged to momentum, which when we plot our momentum charts, they'll usually break out well before the price chart does something similar. And if you look at a GDX chart or a SIL chart monthly, go back to the 2011 peak. Put it up on your screen if you're watching this show. And you'll see that for SIL, there was a total rectangular range, up, down, for 10 years now. We're above it. We broke out above it last month and fully out above it this month. Same with GDX. If you then take the simple technical notion of a swing objective. I would argue this isn't the real objective. It's just the next leg. Measure the depth of that base, low to high, low to high, low to high, and add it to the base. You're going to be up at the 2011 highs just to satisfy that minimal technical swing based on price. I mean, after all, gold's above its 2011 high. Heck, even copper is above its 2011 high. So for silver to get over 50 is sort of a catch-up, really. It's not an absurd assumption. And for the miners to get back up and take out their 2011 high, it's way lagged to gold, but it's a catch-up. And in the process, it'll be rapid, I think. I don't think it's going to be arm wrestling all the way back up to the high. In fact, you've started to see that lately, where it's more vertical than we've seen in a long time. So anyway, that's what price is now telling us. Even price chart is saying, hey, you better be long. I just broke out. And I think once you prick that stock market bubble, more and more of that blood flow will move into the gold and silver miners. And these people aren't going to go out and buy silver futures. Most people don't do that. Maybe they don't want to do options either. But miners, that's a different thing. It's within the stock market. And some of them have pretty good, dividends, especially the biggies.
What do you think of Michael Oliver's take? Is a major melt-up underway? Do you believe silver will reach $60 before the end of the year? Post your opinion in the comment section and check this video right here because it's a perfect fit for you, and I'll see you on the other side.